Hi, this is Stephanie Johnston with the Johnston team of Service First Mortgage, and today I wanted to share some information with you guys about monthly payments and how those are calculated and how we get to these totals. So in this video, I'm going to go through information, an example of a $300,000 sales price on a 30-year fixed conventional with 5% down versus an FHA with 3.5% down. So we're just going to look at those two examples. Now note the principles of how to calculate cash to close are the same. So even if this is not your correct loan type or purchase price, this video will still be helpful in understanding how we calculate the payments. So up here in the portal, this is again your mortgage portal that will that we worked up specific numbers for you if you have already gotten qualified with us on a mortgage. If you have not and you'd like to get some better numbers for your home purchase, give us a call and we can work up a customized mortgage plan for you with specifics to your home purchase. So in here, we're on the payment breakdown screen. First thing is just going to say our sales price, so $300,000 in both scenarios as we talked about. And earlier on the portal, before we get this screen, it does show, the 5% down. Next screen, other video we've got goes through closing cost and how to get to cash to close. But again, on this one, this is 5% down. So the P&I is your principal and interest payment. So that's the payment that usually you see quoted on online sites. Some sites only quote this and do not quote the rest of the numbers and give you that's to purchase a $300,000 house. As you see, 1381 is much different than the 22 figure at the bottom. That's we want to make sure that all payments that you're looking at are going to include all aspects of the home purchase. So the 1381 calculate here is a little bit different than the FHA in this example because we have more money down. So we have 5% down versus 3.5%. And then FHA requires a 1.75% upfront mortgage insurance premium to be charged, and that rolls in the loan. So the loan amount is higher in option 2. Now, good figure to to work with is that $5 is all your monthly payment changes for each $1,000 you borrow. So if we had worked up a scenario on a $300,000 house and you needed to change your offer or look at a home that was $5,000 more, it's only going to move your mortgage payment about $25. So a couple thousand here or there is not going to make just huge dents in your mortgage payment. But of course, we want to make sure it all adds up. So have a cutoff period that makes payments comfortable for you. So those are the big differences there. And then interest rate, of course, makes a difference as well. And we'll have some more videos that will show you a little bit more about the market and how that's indicated. In this case, we use the same rate on both scenarios. So the next one is going to be property taxes. And we try to estimate high on this, that the numbers that we've given you we hope are going to be on the high side and that taxes are lower than that. But we do recommend usually calling when you have a specific property picked out so we can give you exact numbers on that house. This bucket will be the number one thing that will change depending on the taxes on the home in any part of the payment. So again, a couple $1,000s, not going to move my principal interest much. But my property taxes from one house to another can be quite a bit different. So property taxes are based on 3 things: your property tax value, your tax rate, and then exemptions. So property tax value is determined by the county in which you live in and can change every year you own the property. It may or may not change. It could go up, it could go down, but the county has the right to change it each year. So in May is when you would get the notice of value for that specific year, and they would tell you how much the house is going to be taxed at. The taxable value is different than what this house is worth. So you could purchase a home where the taxable value is quite a bit lower than what you're buying it for, or you could buy one where the property tax value is right in line. Of course, the lower that number is, the better, because you're saving money in taxes, but something that you would want to know as to if this number was really low. So on your MLS listing sheets or online, it'll give you the taxable number, but it doesn't tell you how you got there. So if that number seems really low, we'd want to show you how that number is calculated so that you can know if there's risk of the taxes going up in the future. So again, taxable value, different than the value of the home, and is just going to be how much the county says the property is worth. Now in this example, we are using the sales price to calculate this. So we are using $300,000 to come up with this $625 figure. which is why it should be, on the high side. We normally don't see houses taxed for over what you're buying it for. It can, but not commonly. The next item is going to be a tax rate. So Dallas-Fort Worth is going to have different rates for each county and city that you buy in. And I wouldn't not purchase a home because the tax rate's a little bit higher. I would just know the numbers and be comfortable with them and how that's going to affect your payment. So we see usually tax rates between the lower 2s to some areas up to as high as 3.3%. So if you looked in one area that taxes were, 2.3 versus 3.3, of course that's going to change your tax figures. In this example, we use right in the middle, right at 2.5, and that is pretty common for most areas. That upper 3 is not something super, super common. And we would, of course, let you know if you're looking in areas that do have over, more expensive tax rates than normal. So again, we use the 2.5, and that should be sufficient for most people. That's where this number comes from in this example. Then the last item is going to be the tax exemptions. So when you own or occupy a home, you get a tax break. So each county will give you a tax break if you live there. And there's more rules, surrounding that. That's something we'll go through in your consultation if you have any questions on that. But you get a break for that. Also, over 65, there's disability exemptions, there's VA exemptions, there's different ones that are going to lower your tax rate. And each county and city are a little bit different. And we usually try to estimate without those up front and, again, show you what those details are specific to you. So enough about taxes. I know I focus on that a bit, but it's obviously one of the biggest numbers on the sheet. We just want to make sure you understand. Now, the next one on here is going to be your hazard insurance. So that is the same thing as home insurance. Strange way to put it, but it's the same exact thing. So you are going to choose an insurance company for how much, who you want to use, and they're going to give us an exact policy. We get as close as we can based on the current market of, what's gone on in disasters in the area, where you're buying, square footage, location, that kind of stuff. But of course, we don't know the specific home until you find one, and we are not an insurance company. So we're getting as close as we can when we give you your exact scenario. But that'll be something that you'll get an actual insurance quote from an insurance agent as soon as you do get a house under contract. And we do recommend getting that quickly after contract to make sure that you know how much that's going to be, because as you see, that affects your monthly payment. So again, we're going to collect the tax insurance with the payment in most mortgage situations. So then this scenario we have in here, the 130. And note, there are options if you put more than 20% down on certain loan products. You can pay your tax insurance separately from the mortgage payment. You still want to factor them into cost of home ownership, but it is something that you're allowed to do with at least 20% down on some loan products. Last item here is mortgage insurance. So PMI is insurance to protect the loan in case of default. So it's something that's needed if you do not put 20% down, again, on most loans. So in this scenario, we've showed you monthly mortgage insurance, and on the conventional loan showing 104 and the FHA loan 203. So one thing to note on this is that conventional mortgage insurance can be dropped, so that can be removed. And currently FHA mortgages, new ones taken out, that PMI is for the life of the loan. I do have some additional videos on conventional dropping mortgage insurance if you want to check those out on my website or YouTube, and also some information comparing and contrasting the two loan types that get more into detail on this. But as you can see with this scenario, the conventional loan is a lot cheaper in that mortgage insurance. Then we get down here to the total. So this all totals up to your monthly payment. And then one last thing to note on here is this HOA section. We don't know how much or if your house is going to have an HOA, but when we do, we'll add that in here. If your property does have an HOA, a homeowners association, those are paid outside the mortgage. So we usually include it in here just to show you your total expense for home ownership each month, but you would pay that to your HOA separately. So I hope this information is helpful and gives you some more insight under understanding your monthly payment. Reach out if you have any questions or, again, want us to run a specific scenario for you. And again, it's Stephanie Johnston over at Service First Mortgage, and the next slide will have all my contact information. Feel free to reach out. Have a